Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 46. On today's episode, we're going to talk about this crazy market again. It seems like it's never going to stop going down, although yesterday, Friday the 13th, was a pretty good day, so we'll see if it holds. We'll discuss that, but really the main topic for today's conversation is buy now, pay later. Buy now, pay later programs have exploded over the last couple of years. And so I'm going to share my insights on how you can protect yourself as a consumer, give you a little knowledge about these programs so you can see if they're right or wrong for you. So with that, let's get to work. Well, thanks for joining me again, everybody. I know that it's painful to see the market drop every single week. This is 7 straight weeks down for the Dow. That has not happened for over 20 years. And in full disclosure, I'm not your financial advisor, so don't buy or sell anything based solely on what you hear. Please consult your financial advisor before making any decisions, and past performance is not indicative of future results. That being said, I always try to be as honest as possible. I will let you know that I bought things this week for myself and for clients, and some of the things I bought for myself, which I can disclose here. I bought more Apple. I bought more Microsoft. I bought some Airbnb on the riskier side, some Shopify, which I've discussed in the past. Bought some Microsoft, bought some Plains All American Pipeline. All the companies that I discuss here on this program, I went back and bought some of those for myself. Bought a lot of Apple as it dropped this week. And so you end up having to, at some point, say, okay, I got to go into the fire, and you have to think long term. It's all the things we've talked about already. This is what we've been discussing for the past year, waiting for the market to drop, waiting to have a big correction. This is more than a correction. We've actually hit bear market. So a correction is a 10% drop, and a bear market is a 20% drop. Well, that's where we're at. I think the NASDAQ's down 25% for the year. And so you read a lot of things, and it says this is the worst start for the stock market since 1970. But do you know how 1970 ended? 1970 ended with the market down minus 0.9%. So just a hair better than a 1% drop. And so, while everybody else is running, you got to be willing to, look at some good companies, and you got to be willing to kind of step in there. Now, there will be some companies that have dropped that are going to hit concrete, because if you're not a real company, you don't have real earnings, you really don't have a good customer base, man, it can get really ugly for those type of companies. And it's probably not going to get better for some of those, because even though some companies have dropped 80, 90%, when you look at good, solid American companies like the Apples and the Googles and, whoever you want to throw in there, and those are down, well, those are the ones that people are going to, that investors are going to go buy, because they're going to see those companies and go, man, that company's become an accidental high yielder, if you will. Another one I was looking at this week is Home Depot, which is at 296. And earlier this, at the end of the year, it was at 415. And so you look at some of those Dow Jones companies, right? Those 30 Dow Jones companies, and you see how they've been beat up, and it's kind of hard not to go in there and buy some of those. Goldman Sachs is another one that I purchased. Goldman Sachs was at the start of the year, let's say it was $400. And now it's all the way down to 300. And so you just have to be willing to, be patient. You have to be willing to buy a little bit more if you can. I mean, this is the kind of time period where I'm constantly transferring money from my checking account over into my investment account. And I mean, like, if I can spare $500, $200, $50, whatever it is, like, I'm constantly moving money, checking my couch cushions, looking for change, trying to find the ability to be able to save a little bit more money and really push myself as far as that's concerned, because I want to make sure that I can, increase my share count and really put this to work as much as possible. And so, you look at some of these numbers out there and they're pretty scary. And the one I keep looking at is how much value, or not value, but how much money has been lost since this started, right? And so you'll see this, especially if you're on social media, you're going to see this chart a lot, but it shows how much money was lost during the dot-com bubble of 2000. That was 4.6 trillion. The global financial crisis was 2.3 trillion in 2008. 2020 COVID sell-off was 4.4 trillion. And then here, the current decline that we're in right now is $7.6 trillion. Now, of course, that doesn't take into account, when you read that number, the one thing that you intuitively should think about is that's not adjusted for inflation. The 2000 dot-com bubble of 4.6 trillion, if you adjusted it today, would be like, I think 7.3 trillion, somewhere around there. So it's about as bad as the dot-com bubble. But one of the things that's scary, you look back, I always tell students or clients or whomever, when you look at the dot-com bubble or the global financial crisis, or now the COVID-19 crisis, you look back and you see that huge drop, and everybody looks at it, or most, people who aspire to be investors, they look at that and they go, man, I would have been able to weather that. And I go, yeah, but you look at a chart and you say to yourself, I would have been able to handle that, because you can see what happens after the drop, and you see the bounce that came later, and you see it recover, and you say, and you see that everything was okay. And so it's one of those things where, when somebody tells you, when one door closes, another one opens, but it's hell in the hallway. And that's kind of how it is right now in the market, right? I mean, it's not fun. The conversations I have with clients, I mean, they're not hard conversations, but it's, hey, you got to be patient. And I'm going to use a really bad metaphor here, but it's, everybody wants to, cook with their portfolio with the microwave, but that doesn't taste very well, right? You got to be able to think longer term. You got to be patient. You got to think about, if you're barbecuing or whatever, it takes a while. Good food takes a while. It's the same thing with your portfolio. So think about 18 months from now, 2 years from now. Where do you want your portfolio to be 5 years from now? And this is when you're going to be able to build it. And this is when you're going to have prices that are going to come in that are going to help you, start building your portfolio. And I get that it's scary, and I get that it's nerve-wracking, but this is when you got to start dipping your toe in the water. And I have somebody that I know they've had a lot of cash on the sideline since 2000. And they keep telling me, I'm going to wait until the market drops to put money in. I'm going to wait until the market drops. So I call them this week and I say, hey, how much have you invested? And they say nothing. And I go, this is what you've been telling me for 2 years. This is what you've been waiting for. Like, this is exactly what you've been waiting for. So, don't be your own worst enemy like most of us are. And it doesn't mean that if you have cash on the sideline that you put it all in one day. I mean, you never do that, right? You have to, again, like I said last week, this week, probably the week before, if you invest in something, you got to be willing to buy more of it if it continues to fall just a little bit, right? And so remember, the definition of investing is investing in a company for at least 2 years, right? Traders hold things for less than that. And when you look at the crypto market and you look at all of these markets, right, they're all getting beat up. I mean, I think Bitcoin's down 50%. I think 45 to 50% of every single person that invested in Bitcoin is now underwater. It was supposed to be an inflation hedge. That hasn't worked out so well. I mean, it trades more like a NASDAQ tech stock, right? So you look at everything though. You look at the bond market, just getting completely beat up. You look at the equity market, stocks, they're getting beat up, everything, just everything. And so when that happens, you have to realize that at some point, the reason it gets worse is because there's some people that are selling because they have to, not because they want to. And so when investors use leverage, which is borrowing money, or in the stock world, that's going to be called margin on their account. When stocks start to go down, they get what's called a margin call, which is the person who's loaning them money, normally the place that they trade through, says, hey, you got to put more money in your account because you're starting to owe us too much. The value of your investments has gone down. And so if they don't, they get what's called a margin call, which is it forces them to sell. They have to sell whether they want to or not. Well, those sells trigger other people's sells, which constantly pushes the market down. And it's basically like a zipper being undone. And there's forced selling all across the board. And it kind of, flows everywhere. And if you're kind of, increasing your knowledge base of how the stock market works, obviously listen to this and hopefully I can help you a little bit. When you know these things, it kind of makes you feel a little bit better because eventually, fund managers and smart investors are going to go in there and they're going to start picking up the good companies that have been beat up. And time again, the companies that lead their category or their industry are proven to be the ones that recover the fastest, right? So that would be the Apples, the Googles, whomever, Home Depot. It'd be those kind of companies are the ones who normally lead the market back higher after the sell-off ends. And at some point, the sellers will exhaust themselves, and the people that are still invested are just going to be like, okay, I'm in it, like I'm here. Yeah, it's bad, but I'm hanging out, and so. You see that when, the behavioral finance piece of this is that when investors start to lose money, unfortunately, they become risk seeking, which means that, hey, I've already lost this much money. I'm just going to go down with the ship. And, depending on what kind of companies you own, that could be maybe I don't know. It's not really, depending on the type of companies you own. If you own a good, solid company and you know that their balance sheet's good and that they're going to be able to pass along inflation costs to their consumers and they're going to be able to ride it out, it's not a bad idea. But if you're in companies that are risky and they really don't have earnings and things are not looking good for them, you could be in some serious trouble. And so that's why if you go back and listen to the episode on the balance sheet where you look at, are the companies that you invest in, are they real companies? Do they have real earnings? Do they have real customers? Or are they just projecting growth and earnings far into the future? It could be, a different ride for a lot of people. So there's going to be a lot of lessons that are going to be learned in this sell-off that we had. If you're looking at message boards and things like that, you're going to see some horror stories of people that have lost real money and it's impacted their life in a real way. Same thing happened in the tech bubble. Same thing happened in the financial crisis, COVID, all of those things. It always happens. I mean, there's always going to be those kind of stories. So, you have to run your race. You have to start building your portfolio, and you have to think long-term about what you're really doing here, changing your future, changing your family's future, and really making sure that you understand the amount of risk you're taking and that you understand the companies that you're actually invested in. So my apologies for that 13-minute soapbox on that, but we all need to hear that. The pain train isn't going to last forever. I don't know if I'm telling that to you or to me, because there's nothing worse than, watching the amount of money you have drop every single day. Like, it is super painful, which is why it's not for everybody. But if you stay the course and you don't panic, always remember, panic is not a strategy. And that is the hard part about investing, because you can always sell it and end the pain right away. But intellectually, you should know that that's not the right move. All right. So the main thing I want to talk about today was buy now, pay later. Right. So this is this new consumer debt product where everybody can buy now, pay later. Affirm's doing it. I think some of the other ones, what is it? Afterpay is another firm that's big on this. And I just want to kind of share with you just some of the pros and cons of this. And Generation Z is the one who's really getting hit with this because they have cool apps. They need money, all those things when you're young. And the problem is that it is growing super fast. And unfortunately, some people are really getting in trouble with this. And so Generation Z has increased their buy now, pay later by 925% over the past year. And in California alone, 91% of all new consumer debt has been buy now, pay later. And so I think that's the scariest part to me is how much consumer debt has increased. And that, over the last couple of years. And so let me just find these statistics for you. So consumer debt has crossed $15 trillion and it grew by $1 trillion last year, the largest increase since 2007. And what's kind of shocking about that is when you think about how much money the government gave out during COVID, the fact that we're increasing our consumer debt balance by that much should be kind of scary to all of us. And the problem with the buy now, pay later is that most young people who are signing up for it don't understand kind of the consequences that can show up based on late payments, interest rates, things of that nature. So it sounds great when you do it. You go to buy something, it says, hey, it's the old infomercial deal. Here's the cost, but we're going to break that up for you into 4 easy payments of whatever, $19.99. As long as you pay us back, there's not going to be any interest accrued. Sounds great. So what could possibly go wrong, right? Well, at this point, 50% of Gen Z consumers are missing their payments. 50%. So now they're getting hit with late payments. They're getting hit with interest. And what's the problem with it is that it, depending on whenever you miss a payment, it back charges you for all the interest. And then it also, because normally they give you, like, let's say you go buy a pair of shoes today, they give you 6 weeks to make those payments. So if you miss a payment or you're late, everything's based on that. And sometimes they can charge you interest up to 30%. Now, I've worked in, finance for 20 years. I worked for a bank for 7, I think. I mean, I know a lot about consumer debt. I went to Afterpay's website, and seriously, I've been looking on their website everywhere, trying to figure out how much their interest rate is if you start to not make your payments. And after going over this site, like everywhere I know to look, I cannot find how much interest they pay you, which is not good. Because this is so new, there's really not much consumer protection for this, like there are on credit cards and things of that nature. So that's another kind of scary piece because it's so new that, kind of a lot of people are going to be able to get themselves in trouble, and there's not going to be the protection that other consumer debt, credit cards, things like that. Not that they're any better, but at least you can find out how much you're going to have to pay. This is a little bit more opaque right now. And so my advice to you is just to be careful. So when I was younger, when I was in college, we had a lot of people, a lot of credit card companies that would be on campus, and they would, they'd offer you an extra large t-shirt that was made out of like wool, basically, like the cheapest cotton you could get. And they would say, hey, if you sign up for a credit card today, you get a free t-shirt. Of course, everybody did it. And all of a sudden we're buying CDs and things like that. And then, CDs go away and everybody's still trying to pay their CDs off because they have credit card debt. Now, I didn't do that, but I want you to know that even I was once young, obviously. And so when I started doing my MBA, I said, man, you know what I need? I need a good desk. I need a good desk because, I've made it. I need to feel like I've made it. And so I go to a furniture store and they give me, I think it was 18 months no interest on this desk that I had no business buying. No business buying. I could have used my kitchen counter. It's just ridiculous. Okay, so I buy this desk. I forgot how much it was. Let's say it was $3,000. I had 18 months to pay it. And so I'm making the payments. I am making the payments. And then I realize, I start reading the fine print, and it says if you miss one payment or you don't pay us back, or and you don't pay us back in the time in the time that was specified, we can back charge you for all the interest from day one, which was basically like another $3,000 that I had, it basically made the desk twice the payment. So all of a sudden I get worried, I get nervous. I'm, skipping lunches. I'm trying to pay this desk off as soon as possible, pay it off early because I didn't want to get back charged for all that interest. And so that's what's happening to these companies is they're all of a sudden realizing that nobody's paying them back, which, unfortunately, this is how they make money, right? Like they're counting on people not to pay them back. And so you look, and I'm looking right here, and it shows you the app, and it tells you like how much they'll charge you if you pay it back in 10 days, and then due in 30 days, and then due in 60 days, and the numbers jump from like $25 to $52 to $105, and so my goodness, if you wait 60 days to pay this, it's going to charge you a ton of money. And so unfortunately, there's going to be, there already is consumers that are getting themselves into trouble by not making these payments. And so why do people sign up for this? Well, number one, it's easy. It's like 4 steps. You can start paying for things in person or online. They're not really checking credit scores. However, if you don't pay them, they send it to the credit bureaus, which is going to damage your credit scores, because the number one thing for your credit, the number one component is paying your bills on time. That's number one. And so, if you're not paying attention to these things, you can get yourself in trouble, and many young consumers are starting to do that. So make sure that you're very careful when it comes to these buy now, pay later programs, and that you protect yourself. Because unfortunately, and I need you to listen to this. This is the whole reason you're listening to this podcast anyways. Unfortunately, a lot of people make money off the ignorance of others. And you don't want to be one of those people that they're making money off of, right? So you have to educate yourself. You have to make sure that you're protecting yourself, because there's not a lot of people out there that are going to try to protect you, right? So there's a lot of money made off the ignorance of others. And so protect yourself. If you're looking at these, or if you've signed up for these, make sure that you understand the terms and you don't get in over your head, because, they're they're running all these specials. There's deals from Ulta, Sunglass Hut, Crocs, Nordstrom's, all these places where if you use them to buy things, they'll give you a discount. But the reason they're going to give you a discount is because they know later on they're going to get it back from you in the form of, late payments or interest. So protect yourself, know what you're getting yourself into, and don't, put yourself in a position that, costs you later on. Because unfortunately, if you don't handle your consumer debt, or you don't keep yourself out of debt, investing is going to be hard. Because, I always recommend to people, make sure you pay off your credit cards. Make sure you pay this stuff off, because credit cards are going to charge you, and obviously the buy now, pay laters, they're going to charge you a lot more interest than you can probably make in the stock market. So if the stock market's average is 9% a year, and you're paying 18% average on your credit cards, it's not a good place to be. You got to get that stuff paid off before you start investing. And I truly think that right now is going to be a good time over the next 6 months if things are choppy. It's a good time for you to be able to start investing if you haven't, but not if you have a lot of consumer debt, and not if you're, racking up, a bunch of debt. So you have to make sure you pay attention to that. So That's your homework this week. Check your consumer debt. Make sure you're not doing things that are going to put you in a bad position going forward, and making sure that that you have that, that you understand that, so that you can build a solid financial foundation, because you have to have a solid financial foundation to be able to build things up, right? So, all right, so that's it for this week. That's enough soapboxing for me. I appreciate your time, and I'll see you next week. Thanks for tuning in, everybody.